All right, everyone, good evening. Today is Monday, October 19th, and let's walk through the market news of the day. To kick things off, let's talk about the falling equity markets. We see a tone of continued skepticism across the board, and this is really reflected in the downside movements in the U.S. equity markets, with the S&P 500 down 1.5%, and the Dow down accordingly. We saw the Nasdaq logging its fifth straight drop, and the Dow moving to its worst level in 4 weeks. We also saw a modest loss in oil following the OPEC meeting today. So they failed to prop up prices, even though they did reiterate the idea that they are going to commit to production cuts. They said that they encourage participating countries to increase efforts to compensate for the overproduced volumes to further rebalance the market. Obviously, this is not surprising given the demand shock that the world has seen, and oil ended up being down a nickel. So it is still trading around that $40 range. Gold futures ended higher on the day, with COMEX up slightly. Because of the developments out of a potential US stimulus deal, we see that we're being further buoyed by weakness in the US dollar. All right, so today we're going to do a deep dive into SPACs. SPACs are special purpose acquisition corps, which are companies that are publicly traded that acquire privately traded targets. So this is something that we've seen a lot of in the current market environment, given the heightened volatility and the private companies not wanting to be exposed to market risk as they do decide to go public to raise funds more easily and raise more funds. So the first one we'll talk about is FS Development Corp, FSDC. Their merger target is Gemini Therapeutics. Obviously, in the medical industry, they're within age-related macular degeneration therapy and will have a pro forma market cap of 479 million US dollars. The public will own 26% of the deal, with the sponsor owning 11%, Gemini shareholders 46%, and the PIPE, the PIPE, the private investment and public equity investors, providing nearly $100 million, who will also own 17% of the resulting entity. They'll receive $200 million in total and result in a market cap of about $479 million when it is publicly traded on exchanges. So CC Newberger Principal Holdings is targeting E2Open, which is a SaaS, a software as a service company within the supply chain software realm. The pro forma market cap is going to be a little bit over 2 billion US dollars, and the company was taken private by Insight Partners, a private equity fund, in 2015. The cloud software company has over 1,000 large blue chip customers in at least 5 verticals spanning things across tech and automotive. The private equity company will still own about 40% of the resulting entity, receiving nearly $700 million. The public will own 20%, with the tech company founders still having 7%, and the public investment is in private equity investors having 25%. The SPAC sponsor itself will get 7%. Replay Acquisition Corp is targeting Finance of America Equity Capital, which is within the mortgages, reverse mortgages, and fixed income industry. The pro forma market cap of this resulting entity will be nearly $2 billion, and this is an end-to-end lending and service platform. The pro forma equity value of nearly $2 billion at the price of $10 for our RPLA will allow them to raise $250 million through this public investment in private equity investment. We see Blackstone. We see that Blackstone will end up owning about 70% of the resulting entity. Obviously, they're a private equity firm with a huge presence in American real estate markets. Churchill Capital 2, CCX, is targeting Skillsoft, which is a digital learning company. This deal is particularly fascinating because it's actually a three-way deal. Immediately following the transaction, the company will buy Global Knowledge Training for nearly 230 million US dollars. This digital learning and IT and professional skills development company will further develop the new platform. The pro forma market cap will be $1.2 billion, and the CCX public company shareholders will own about 65% of the combined company. That obviously is incredibly high in comparison to other SPAC deals, where the public company owners usually have less than a quarter of the total. So that was true in the last 4 that we discussed. There also is a notably large amount of debt, $463 million US, that's going to end up with the resulting entity. All right, so last one on your screen on the far right is AMCI Acquisition Corp., which has the ticker on the NASDAQ of AMCI. Their merger target is Advent Technologies, which is within the hydrogen fuel cell technology industry, and has a pro forma market cap of nearly $500 million. Advent shareholders will be in control of the company, having a little bit over half, 52% of the total outstanding shares. Advent shareholders will be in control of the company, even though this company obviously is not yet profitable. And the deal range will raise about $122 million for Advent, allowing it to ramp up production and hopefully turn cash flow positive soon. All right, so for some broader stories to talk about, we've got two mergers to talk about. First, in the top left, in the middle, and then we have a debt raise and a couple other interesting things to touch on. For the big merger of the day, there's a nearly $10 billion deal, a $9.7 billion merger between ConocoPhillips and its shale rival, Conoco, for nearly $10 billion. This is the largest independent oil and gas company nationally, with $60 billion of enterprise value for the combined company and a 23 billion barrels of gas in their summed portfolio. They're the dominant operator in the Permian Basin, which is in West Texas and New Mexico. This goes hand in hand with the market's growing appetite for consolidation. However, not surprisingly, it does risk alienating investors, not only because of the proliferation of funds earmarked for ESG investing, which obviously does not bode well for an oil and gas company, but also because of people being worried about the company's spending and declining returns given the ongoing downturn in oil prices. The combined company will have a whopping $12 billion of debt. And the transaction will allow the companies to save about $500 million in annual costs by 2022. So obviously this is going to be the cost synergies and a big impetus for the merger. There are 1.46 Conoco shares for each Concho share being exchanged, and ConocoPhillips shares fell a little bit more than 1% to $33 on the news. However, Concho shares also fell a little bit less, fell 50 basis points to 48.34 on the news. Obviously, the deal's not approved yet. It's just announced and will be expected to close in Q1 2021. Front Yard Residential is the second merger we're going to talk about, with a buyout deal by Putnam and Ares Management valued at $2.5 billion. It soared 33% to a near 3-year high on the news pre-market. Putnam is a big private equity fund that does focus in real estate markets, particularly on the single family side, just like Front Yard. Mullen is a former Goldman Sachs partner, and he founded Putnam in 2012. Obviously, coming out of the dearth of the financial crisis, this was one of the early waves of Wall Street firms created specifically to invest in single family rental structures, which does realize cost synergies and build economies of scales that do make these sprawling national portfolios of rental houses a lot easier to manage. So Front Yard owns about 15,000 homes, and 3/4 of Front Yard residential rental houses are in markets where Putnam already has an existing footprint. Amherst Holdings has announced a deal to actually buy Front Yard back in February for $12.50 a share, the equivalent of about $2.3 billion. However, this deal fell apart in May, given the environment of real estate then. A lot has happened, and we've seen big recoveries, especially on the residential side, where, however, on the commercial side, there are a lot of big questions that still are front of mind. Front Yard Residential will become the second largest landlord in the country, second to Invitation Homes, which owns about 80,000 houses. And they had recently just announced a joint venture with a company out in Boston to deploy more than $1 billion, including debt to both buy and renovate homes. Zoom Technologies, for a quick story, hit a record high today, up a whopping 754% to date. Obviously, that's what we're using to record this presentation. So it's likely that most of you guys use it on a daily basis. It's become an integral part of society, and it was up 4% today. Dave & Buster's had a debt offering as well, which allowed the stock to soar nearly 10% on the news. They've offered $500 million in senior debt private offerings, which is a 144A issuance, which means that it's only for QIBs, qualified institutional buyers. The same company subsidiaries that guaranteed Dave & Buster's their term loan facility and revolving credit facility is also going to guarantee this senior debt. They'll have about 300 million in liquidity following the offering, and they had about 730 million in long-term debt as recorded in its last 10Q report. Comp sales, not surprisingly, have steadily increased. However, were hit incredibly hard by the pandemic back earlier in late spring this year. They were down 62% month over month or year over year in the month of September, with Dave & Buster's stock sinking 60% year to date. Intel nears a deal for a divestiture with regard to a $10 billion deal to sell its memory chip unit. The semiconductor maker was near a deal to sell this unit for roughly $10 billion to South Korea's SK Hynix Incorporated. And Intel stock is down nearly 8% this year, despite a semiconductor market with the semiconductor index going up nearly 30% this year. And the last thing I'd like to talk about today is airline stocks gaining. We see that the JETS ETF was up about 1% after the TSA Daily Traveler data topped 1 million on Sunday. So this is the best daily average of travelers since March 15th. So we see that people are starting to move at least a little bit, despite obviously the ongoing health crisis. The JETS ETF has dropped nearly 50% year to date, down 44.5% year to date through this Friday. So it is nice to see a bit of a rebound there. All right, well, that does it. Thank you so much for tuning in. Look forward to taking your questions and continuing the conversation, and then seeing you tomorrow. All right. Thank you so much.